by leveraging his money more than anyone should, taking casino-like risks, and keeping a few secrets. And because Wall Street has a habit for taking on excessive risk, Bill Hwang found himself right at home within its system. Bill's antics actually worked out well for him for quite a few years, but as they specialized in Asian securities and grew to $8 billion in assets under management by 2007 after realizing a 40% return for the year. This growth was stunted in 2008 when the fund saw a 23% loss, mainly attributed to a failed shorting attempt on Volkswagen stock. Many investors pulled their money as the fund was meant to be focused on Asian securities, but instead took a substantial loss on a European company. This was really the beginning of the end for Tiger Asia, losing 23% after deviating from its strategy and having less than average returns in the following 2 years didn't entice many investors. A total return swap is a contract between two parties that is based on an asset, for example, a stock. The bank, aka the prime broker, will buy a stock, and the investor will enter into a contract with the bank stating that if the price of the stock increases, then the bank will pay the investor the difference, and if it decreases, the investor will pay the bank the difference. Now, this sounds exactly like buying a stock, so why use swaps? Swaps offer the ability for investors to leverage their money. Essentially, if the investor has $100 million, they can offering swaps. While leverage does offer the potential for larger gains to be made, there's also more risk involved. Firstly, in swaps, the investor's money is the first money lost, so any decrease in price is subtracted from the investor's share, not the bank's. Secondly, just as there's the potential to gain more, there's equally the potential to lose more. And finally, there is a margin requirement, which means that the bank requires the investor to maintain a certain percentage of money in the investment. If the margin requirement is 25% and the stock's price drops by 25%, since the investor's money is the first money lost, the investor must replenish the amount lost to stay in the position. If the investor is unable to do so, then the bank can liquidate the position to recover their investment, and the investor will have lost their collateral or original investment, and is also unable to benefit from any recovery the stock price may make. Essentially, hedge funds use swaps instead of stocks so that they can realize a greater benefit from a stock price increasing. While it can be advantageous, it certainly comes with its share of risks. In the case of Bill Hwang and Archegos, it's estimated his leverage ratio was 5-to-1. So for every $100 million he gave the bank as collateral, he would gain $500 million in exposure to the stock. So after being banned from trading in the Chinese market, Bill Hwang turned his attention to American stocks such as Amazon, Expedia, LinkedIn, and Netflix. Using swaps to leverage his money, he was able to turn his initial $200 million investment in 2013 to $20 billion. By March of 2021, Archegos Capital had between $20 billion in assets and between $50 and $100 billion of exposure. Again, the exact number is not known. To make matters even riskier, Archegos wasn't very diversified, holding large positions in a small number of companies, including Farfetch, Vipshop, Discovery, Viacom, Tencent Music, and Baidu. It should also be noted that Archegos was working with 6 separate banks, which were all most likely unaware of the entirety of his investments and agreements with the others. This is most likely how he was able to amass so much risk and take such large positions in a small number of companies. Although Archegos was taking on an enormous amount of risk, he had a good track record that spanned over the course of 8 years, which provided him with a 100x return. So what happened on March 22nd that caused it all to disappear within 2 days? March 22nd, Viacom announces their plan to sell $3 billion worth of shares at below its current price in order to raise capital to invest in their streaming service, Paramount+. March 23rd, Viacom shares fall 9% on the news of the stock sale. March 24th, Viacom shares continue to fall 23%. Given Archegos' large holdings in Viacom, Bill Hwang's prime brokers urged him to sell his position. Although he would be selling at a loss, his fund would still be intact. Bill refuses. March 25th, Bill has an emergency meeting with his prime brokers to determine what to do. Because Archegos is unable to cover its margin due to the sharp drop in Viacom's share price, the banks are able to sell off Archegos' positions. But because his positions are so large, a mass sell-off from the banks would drastically affect the stock's price and cause the banks to realize a loss on the shares. If the stock price recovers, then the banks would essentially be fine. But if even one of the 6 banks liquidates Archegos' positions, then the stock price would be pushed down even further, increasing the losses for all the other banks involved. Some banks, including Credit Suisse, were in favor of holding on to see if the stock's price would rebound. Others, such as Goldman Sachs, wanted to start selling in order to recoup what was owed to them by Archegos. March 26th, before market open, Archegos and Goldman Sachs come to an agreement to sell off $3 to $4 billion of securities held by Archegos. Goldman ends up selling off $10.5 billion. Morgan Stanley sells off $8 billion. Deutsche Bank sells off $4 billion. Because the banks are trying to offload their shares amidst the plummeting prices, they wanted to do so as quickly as possible to minimize losses, and sold off large chunks of their positions at a discounted price. These are known as block trades. By the end of the day, Goldman, Deutsche Bank, Morgan Stanley, and Wells Fargo sold off their positions with minimal losses. Credit Suisse and Nomura, opting to wait to sell, took the biggest hits, and Viacom stock had fallen another 27% and was now down over 50% on the week. Nomura estimates a possible $2 billion loss, while Credit Suisse estimates their losses could be up to $5 billion. The losses, or lack thereof, for each bank could also be attributed to the terms of their swaps with Archegos, including the leverage ratio they offered and the amount of margin they required. As the details of the individual swap agreements are unknown, this is only a hypothesis and is unverified. Once the fire sale had ended and the dust had settled, all stocks and banks involved saw their share prices take a hit. The banks which started selling off Archegos' positions early minimized their losses and had their shares drop comparatively less. Now, it's clear what happened, but why did this particular instance wreak so much havoc? Swaps are something commonly utilized by hedge funds to leverage their money, so what was different in this case that caused one firm to lose $20 billion in 2 days and saw $35 billion in market value evaporate by the end of the week? Firstly, Archegos maintained a very concentrated portfolio. Therefore, the decrease in one stock, in this case Viacom, had a large effect on the value of the entire portfolio. This is why diversification is typically recommended, to ensure that one stock's failure does not put an entire portfolio at risk. Secondly, it appears as though Archegos did not deleverage their position and instead reinvested their gains with leverage. Typically in a swap, if the stock price goes up, the safe and smart thing to do is to lower the leverage ratio. So instead of a 5-to-1 ratio, this would decrease to say a 4-to-1 ratio. This provides a cushion for the investment as the stock price has more room to fall before you would be required to post margin. Instead, it seems that Archegos would take the profits made on the swaps, leverage, and reinvest them, making his investments riskier as their associated stocks' prices rose. So once Viacom dropped by 9% and 27% in 2 consecutive days, Archegos did not have the capital to post margin, at which point the prime brokers were able to liquidate his positions, leaving Archegos without the option to see if the stock's price would recover. And lastly, Archegos did not properly hedge their investments. Hedging is the practice of insuring your investments in case they do not turn out as planned. This is done by shorting a comparatively less amount of the stock that you are long on, or expect to go up, which is done to minimize losses in the case that the stock's price does drop. Archegos used a portfolio hedge, which is essentially a bet against the entire market and only minimizes losses if the entire market drops in value. So when Viacom's stock sharply dropped while the market saw a minimal drop and even rose by the end of the week, Archegos was not able to minimize their losses and their hedge essentially failed. In summary, Bill Hwang took on a large and growing amount of risk in a small concentration of companies and only situationally hedged his investments, which left the door open for one stock and a couple of bad days to unravel his entire portfolio. Because of the lack of reporting required for family offices, the numbers may not be exact, but are as accurate as possible based on available information. And as a result, these so-called family offices may face more scrutiny and regulation moving forward, as this instance has proven what effect one seemingly small operation can have on the entire market. Bill Hwang's net worth is unconfirmed, so how much of his money was tied up in Archegos capital and how much, if any, he has left is unknown. But given his appetite for risk, it wouldn't be surprising if a large portion of his net worth was lost in these investments. But regardless, that $20 billion represents years of work and progress lost in a mere 2 days. I hope everyone enjoyed this video, thanks for sticking around to the end, and you don't have to like and subscribe, but
it'd be a lot cooler if you did.